Tonight, the October steamroller continues. Is this going to be the way it is for the rest of the year? It certainly looks like it. And what about the bank collapse in the small cap banks and the IRS and everything else that shut down in Washington, the second longest shutdown in history? Could that derail this bull market? And finally, earnings reports that are shockingly high, unbelievably high, and you'll see that as we move forward. We are back live from Chicago. It's Thursday, October 23rd. I'm Charles Brown, your portfolio manager, and this is CB3 Live. Well, hello everyone. It's great to be back. A couple items of business before we start. It looks like the chat box is not working. A lot of times you guys will send me comments or questions and I'll get them answered. I'm not sure why it's not working tonight, but I'm not seeing it on this side. If you want to text me, my text box is open here, 312-513-7486. 312-513-7486. And the second thing is we are 2 weeks late because of a medical situation in our family, which I'll expand on in my closing remarks. But we are glad to be back with you here, and it's the October steamroller that's the big story. September, the weakest month of the year, was not that way this year. October, the most unpredictable, has not been that way. So as we move through this, stocks power higher for 3 weeks, defying the seasonal odds, and the S&P is back near record highs. Tech is again leading the charge, but how long can this last? And that, of course, is the $50 million question. How long can it last? Because so far it has been a surprise to the upside and a good one. So how is the market holding up amid credit and shutdown concerns? Shutdown concerns, of course, meaning the government shutdown. Credit spreads are widening. So you're going to see this widening phrase used a lot tonight. What happens is in the bond market, the bid offer from these huge banks and from the government and other major players, institutions, hedge funds, the bid between the width between the bid and the offer widens because there's more risk. And when those bid and offers widen, that usually means that there's more risk priced in, and that leads to volatility in all the markets, not just the treasury markets. But I'll break it down for you why the market seems unbothered for now and what to expect from the upcoming earnings reports. We're already seeing the first 50 to 60 of these and the CPI data tomorrow. Now, you might rightly be asking, how can we have CPI data? Well, because Trump ordered it produced. All right, that's the one report that's sneaking through. Even the ADP earnings report did not get released to the government ahead of time. And Jay Powell is saying, we really need this data. Well, what needs to happen is the government needs to get reopened, as we all know. But so far, that's not looking like it's going to happen. So will these earnings surprises create bigger upside surprises for the market? What are the risks? What are the bigger upside surprises in the earnings that we can expect? No one knows. So we're going to look at the October steamroller right now. So all the majors, and when I say that, that means all the major indices for days now have been resetting momentum and sentiment. So strength. I think when you have a month like September, which for the last 70 years since 1955, all right, has been a negative month. Overall, it has been on average -1 to -1.5%. The only month of the year it's negative. It was not this year. I think our CG program was up 7%. DS was up 8.5%. The S&P not quite that much, but still did quite well. That is sentiment, and that is a great thing in our favor. So already rewriting that worst month story, the inflows, meaning cash coming into the market, positioning, staying supportive for equities. And that's why we are 100% invested in all of our programs. Market leadership is still tech heavy, meaning that the tech sector, which is 38% of the entire market, where most of these trillion-dollar companies live, is what's leading the market higher. But the participation keeps broadening. And I've said for years on this program, small and mid-cap, industrials, even utilities, real estate, consumer staples. We want to see all 11 sectors participating, not just tech. Because if tech gets too far ahead, what happens is if the rest of the sectors don't catch up, then tech can collapse. And that happened in 2008, happened in 2022, even happened in 2020 with the COVID situation. So tech remains the engine for now, but AI spending and cloud CapEx, so that's capital expenditures by these big companies, continues to overpower the seasonal drags. That is the story. So the sheer velocity of the American enterprise engine, and I'm going to show you some really cool charts in just a few moments here, just keep overcoming and blowing away the seasonal tendencies of not only September, but October too. Now, we do have tomorrow's CPI, and unusual to be this late in the month because it's the September CPI, and it's going to be issued on October 24th, but that's what happens when you've had a government shut down for 3.5 weeks. So this rotation to small cap is improving the domestic tilt and policy incentives. All right. So margin expansion pockets showing up. We are seeing margins expanding, meaning companies that are, grossing $1,000, whatever you want to say it in simple terms here, instead of taking home $200 of that, they might be taking home 220 or 230. So the margins, the profit margins are expanding because they're getting better about reducing costs. easier to do when it's a pretty tight labor market right now. And the dividend and income sleeves, and our GI program is part of that, have been underperforming all year. It's really tough when the market is going straight up to compete with that in a program that's 60/40, and 60/40 programs all over the country, all over the world are finding that. But that's okay, because when there is a downturn, then they shine. And GI had a great year last year at 15%. So we will rotate sectors as needed depending on what happens. So what could derail it? That was my opening question, and we'll get into that now. So the rate and credit wobble. So if rates continue to rise, right, first of all, it's going to keep the Fed from dropping rates, interest rates. But if interest rates continue to rise, that's bad for corporations because it means they have to pay more for credit. If they pay more for credit, it definitely affects their profitability. If it affects their profitability, it affects their PE ratio, et cetera, et cetera. It's just a domino effect, all right? And these higher or longer yields or wider spreads, remember I said earlier, that can dent the multiples. We want to see high multiples. We want people willing to pay 30 times earnings for a stock, or something crazy like Tesla, 50 times earnings, all right? Because the future earnings capacity is so optimistic. And when you have lower rates, it's easier to achieve that. Policy whiplash. What we're risking right now is this drama in DC that if this finally gets, well, when it finally gets resolved, not if, all right, there's going to be this strategic uncertainty that Donald Trump talks about. So I wasn't going to use this example, but I think I will. If you've ever been constipated and you take a laxative, you know what happens after that, right? Well, the government right now is constipated with all of this key information that not only do the Fed policymakers like Jay Powell and all the Federal Reserve need, but the consumers across America and the world need this data to make decisions on their spending. And thus the portfolio managers like myself and thousands of others need this data and be able to react to it. And it's all of a sudden just going to be blah. And this has happened before in these shutdowns. I mean, we could have literally 2 months of data spew out because they're not just going to release it, a little bit at a time. I think when the government finally is open, all this data is going to be published, and bar the gates on that. Katie, bar the dates, is that the phrase? But the CB3 hedging tools are ready. The index puts, the spreads I started talking to you about in August. We had a feature on it in September, and we're having yet another feature on it tonight because the biggest question I have ever had in the history of our company is, tell me about these options. They sound speculative. They sound risky. I'm signing the forms and I want to be in them because I trust you, Charlie. But what does this mean? So we're going to go through this again, and then I'm actually going to make you another offer at the very end of the program if you really want to know more about them. But we are prepared with our index puts spreading strategy if the tape weakens. And the tape weakening means the ticker symbols go down, the arrows, down arrows on the ticker symbols with the tape goes across. You see this on the TV programs, right? That's what the tape is. All right. So how is the market holding up amid this credit and U.S. government shutdown concerns? Amazingly well is the answer. So the tape shrugs off for now. Growth in earnings clearly outpacing the fear narrative. You're getting the fear narrative not only from federal agencies that are saying, we don't have any data, so we're not going to be optimistic about anything. And then, of course, the corporate news wants to just get you all riled up that there's going to be this big blurting of data. And there is truth to that. All right, when this is finally settled, but that doesn't seem to affect the market. We've faced a few volatile days, and I'm going to show you one. October 10th was one, but since then, pretty mild. All right. So the positioning is the Fed path is cleared a bit. So Powell has said, yeah, we're open to cutting here, but we need to see our data. Investors need to stay engaged after the September upside surprise, and that upside surprise is what we've been talking about. Normally the market's down, and we had maybe a better month than even November usually is in the month of September. Is it an outlier? Is it a precursor for the rest of the year? If it is, you're going to see the S&P closing at 6850. I mean, it's just really going to be a great thing to see. So here are the three real swing variables. This is what could cause consternation with the market, and this is what we're watching. This is what you pay us to watch. If long rates, and that's interest rates, drift higher, then stock PE multiples will compress. We do not want that. We want to see multiples expanding, because if people continue to buy a stock, I mean, I think you'd agree with me, if a stock's trading at a 40 PE ratio and then its multiples start expanding because, interest rates are dropping, and all of a sudden now people are willing to pay 45 pretty much for the same stock, right? Without any increased earnings projections or anything. That means they're in a very optimistic, some could say euphoric mood and wanting to pay more for that same stock. But that's a good thing, certainly in the short term. We have to watch, though, for this 10-year rate. So the interest rate, and that could move big time around government data when it is finally released. I wish that they would stage this, especially now, because it looks like absolutely we're going to go to November 1st. I can't imagine why they would open up anything even next week. I think November 1st is the best possible situation, which is a Saturday, but so that would mean technically November 3rd. But that's the biggest outlier right now. Could that be such a dramatic reveal of all this data that market participants on November 3rd, if the government were to open, that could just make things crazy. So the Washington, D.C. timelines, if the market and the corporate media noise turns into funding stress, we'll have to tighten the wristbands and not yank the wheel. Again, that's why we have the options hedging in place. That's the value that we bring to you as your portfolio manager now that we are at Schwab and can offer that to you. Okay? So what are we going to expect now from the upcoming earnings reports? These are the three topics I mentioned in my opening line. So the beat rates have been crazy. 86% versus last season. Now, if you've been watching this program since 2020, when I started during COVID, you'll know that 73% beat rate, in other words, 73 out of 100 companies actually beat what they forecast. All right, some companies underperform, or they estimate here and they come in lower and they get walloped in the market. But 73% is a pretty solid number. We're at 86%, even though there's not that many reporting, and I'll get to this just in another slide or so. So the small caps showing surprise potential from last quarter. I'm watching for the follow through on that. And our base case is there are going to be fewer earnings and government data landmines than feared. The guidance tone becomes the driver. This is where the Fed can play a role and say, we're just going to be patient. We're just going to watch. We're going to get the data. Again, as I said earlier, I'd like to see them stage the data. Yeah, we just opened up the government. Here's the CPI from September, and here's from October 2 days later. Just bring it out in stages rather than just vomit it out, so to speak. Sorry to be so coarse, but could be a big market mover if that happens, and I hope they make that decision. Again, second longest government shutdown in modern history. So what else can we expect? Earnings reports and CPI. So again, this CPI report tomorrow, highly unusual, 7:30 Central Time. Is AI, the spending durability with the chips, the power companies, meaning the data centers, the cloud, versus the cost discipline? Can these margins hold? If the margins are holding, the market's going to hold. People want to see that even with all this adverse news and a government shutdown and small cap banks failing, credit risk, so to speak, can the margins hold up? And if they do, the market's going to continue to power higher. All right. What about the tariff, the reshoring impact? Reshoring means companies coming back here because they don't want to pay the tariff. So they're building here. We're going to get into more data on this in just a few slides. All right. What reshoring means. So consumer health. Is the consumer healthy? As you well know, there are three components to GDP, the gross domestic product. There is corporate spending, there is government spending, and then there's the biggie, consumer spending. We are the biggest engine on the planet for generating GDP in the trillions of dollars. We'll get to those charts in just a few moments, but the U.S. definitely needs a strong consumer. Will they continue to splurge? And how this hits the category mix. In other words, which sectors of the economy are they going to be spending, and will they cut back in any? So look at this beat rate. You guys see this chart every time I show the program here. We're only 58. I think by now there's probably 65 companies that have released earnings, under 100. but we're still, just 20 some days into the quarter. And actually the banks don't start until about the first week. So look at this beat rate. Consumer staples, 100% of the companies, energy, 100%, financials, 92%, industrials, 89%, real estate. So technology, a little underperforming, but gosh, if you're going to underperform at 80% when the mean is 73%, that's not so bad, right? That's really good. All right. So we are heading for a really strong third quarter earnings. So why are we doing this? Just a reminder, this is the fourth quarter, but we're looking backwards for the third quarter. In the first week of January, we'll be looking backwards at the fourth quarter of 25 earnings. But this data you see right in front of you is a great omen. What's the monthly market review? Pretty straightforward. A lot of people have been asking me this, not a lot, I don't know, 4 or 5. So I decided to put this slide in. Why did we drop GLD, which is the gold ETF, from CG and GI? Well, my answer is simply this. Although gold glitters, earnings compound. So yes, gold has been going higher until it just got destroyed 2 days ago, down 6% in one day, even more than Bitcoin was down. All right. When you get in the stratosphere with any of these commodities, it is riskier to hold them. So we exited out of gold and went into companies that are compounding. And we'll talk about that as we move forward. But that's why we made that decision, just so you know. So this is the data that I said I was going to show. The total world economy in 2025 is $115 trillion. Of that, the USA is $30 trillion, well over 25% of the entire world economy. Staggering. Not 25%, 22%. Sorry about that. Look down here at, so people say, we have to get along with Canada. We have to get along with Mexico. They're our bigger neighbors to the north and south. Well, they might be bigger geographically, but look at their GDP. 2.3 for Canada, 1.8 for Mexico. And there's Russia at 2.2. There's Germany, DEU is Deutschland, or Germany, 4.9, just under 5 trillion. Remember that number for the next slide, okay? 5 trillion. But you can see we are absolutely the biggest dog on the planet. And as long as our economy stays strong, we will drag the rest of these countries with us. This is a different way to present the data. On the left-hand side, you'll see the 10 largest economies. Again, US and China. And there's always an asterisk with China because they're never going to put out any data that makes them look unfavorable, even though they know they can't possibly compete with us right now as far as GDP. And here's the really cool data on the right-hand side. So what is the per capita? In other words, what per person is being earned? So the average in the US, a worker in the US is creating $89,000, let's just call it $90,000 of GDP. In Germany, 55,000. Canada, 53, and it just drops from there. China's way down at 13. We are the most unbelievably efficient. The only reason that China even competes with us is because they have 6 times our population. But that would explain why with their GDP per person, per worker is so much lower than ours, all right? Why am I showing you this data? Because I want you to be encouraged that we're investing almost entirely right now, not so much internationally. We were doing that earlier this year, but right now domestically, because this is where the strength is, all right? This is where the strength is. Now, remember I said, remember Deutschland? So NVIDIA is a little higher than this right now. It's about 4.45, I think, just under $4.5 trillion, the size of the company. That is equal to the entire GDP of Germany, one American company. And if you add all of this up, it almost dwarfs everything except the US and China. It's just staggering. And if you are in our CG, which every one of our clients has a CG account, and if you're also in DS, and many, many of you have DS accounts, you're in every one of these stocks in varying weights, all right? There it is. There are the stalwarts, the really, really big growth engines of America. You guys know this chart. I show it every time. This is looking back 100 years. It's really easy to sort of pigeonhole, if you will, but effectively that's what we're doing. This is the from 2025 pardon me, 1925 to 2025, 3 secular bear markets, 3 secular bull markets. The bear markets are pretty bad, but even then, they still are positive. They're just positive by not much. The bull markets, though, this is what I want to draw your attention to. This current bull market, look at the red box to the right underneath the plus sign and the 155 there. Go straight down with your eye. April 10th, 2013 is when the market broke out of that consolidation. Let me go back and show you that. All right, back and show you. See how it broke out of that April 13th, 2010. And we have been in a secular bull market. Notice that the market does go down in secular bull markets. And you'll see, lean in on your monitor and look at that where it breaks through the bottom of that channel. That is COVID. All right, but did it last? It did not. It was the shortest bear market in history at 7 weeks. 7 weeks. Crazy. All right. So if this 20-year propensity to last as a bull market continues, and we started in 2013, let's do some quick math. This is 2025, 2033. According to the back look at the math there, it's 8 more years of this. And I'm seeing this in the behavior when we see even these dark times that are happening politically, geopolitically, these wars across the globe, the government shut down, fuel costs better now than they were, but still not easy for people to deal with. Inflation definitely not totally under control. And yet the market is flirting with lifetime highs and will likely take it out before the end of the month or certainly in November. So it is hard to overcome a secular bull market. That is what we do on your behalf. We follow this. We want to keep you informed so you know why we're doing what we're doing. I zoomed in here and just showed you since 1980. So look on the far left side. That's the previous secular bull. And then you can see this oscillating from 2000. They call it the tech wreck. You can see it going down there. Now it rose up in 2007 and 8, looked like it was going to break out, but it didn't. It came back down in 2009. That was the financial crisis with all the banks going under, Lehman Brothers, and just a real mess. But then once it broke out, you can see in April 2013, we are still in that uptrend right now. I'm going to rest my voice just for a little bit. And if you've got questions, just send me a text. Okay, guys, I don't know why my chat box is not working here. All right. So U.S. policy, guys, you know the story. U.S. policy is important. We have to deal with the politics to get there. Hate politics. I don't blame you if you do too. But politics eventually, not right now with a shutdown government, but eventually it will lead to policy. And policy has portfolio impact. And portfolio impact has personal impact. All right. So there he is, affecting everything from tariffs to pretty much every aspect of the economy. Love him or hate him, he is the busiest, most active president in history. Almost every day, Saturday, Sunday included, he's doing something, and he's not even 25% into his term yet. So what's going to happen going forward? So this shutdown and the spending chess, right? It's a chess game. Let's face it, this physical year-end brinksmanship, the White House is framing it as we're going to be disciplined. We're not going to do something by default. In other words, we're not just going to reopen the government because that's what everybody's expecting to do. We think we're on the right side of history. So we want to reopen the government and then get into discussion. The Democrats, as you well know, don't want to do that, but they're going to eventually have to cave because Trump will start issuing executive orders if he has to fund certain imperative operations that need to happen. So the Treasury cash levels remain healthy, but the federal agencies have begun, I would say more than begun, they're well into now their pre-shutdown contingency plans. The markets historically have shrugged at this, and they're doing it now until missed paychecks hit consumer sentiment and thus consumer spending. Why? What did I just say earlier? And I've been saying for the 5 years I've been doing these, the consumer in the U.S. economy is 68% of all of our GDP. What was our GDP? 33.1, right? Go back 8 slides. All right. If the consumer slows down, if the consumer hiccups, the U.S. coughs, and everybody else around the globe gets pneumonia. That's the reality of it. All right. The bond market watches this calendar, not the noise. The bond market is bigger than the stock market. All right. So realize that the bond market is paying extra attention. We watch the bond market like a fiend. We don't necessarily trade it, although we do trade fixed income in GI. The T-bill spreads widen first and then stocks follow days later. You don't want to see bid offers widen. Think about it. All right. You want things to be tight. You want stocks to be 1 penny wide. In other words, if you want to buy Microsoft, if it's trading at $100.01 or $100.02, the bid and offer is 1 penny wide. And that's typical. There's some stocks like NVIDIA where it's half a penny wide because it is so liquid and so well supported that there are people that are willing to narrow that bid offer or the spread. When you see that widening in the bond market or the stock market, that raises an eyebrow, and the wider it gets, the more concerning it gets. So expect another last-minute extension labeled a deal. Yeah, sure. Even though it's definitely not in sight yet. I don't see anything in sight that's going to stop this right now, right? Maybe you see something I don't. Feel free to mention it. Again, I can't see your here, but send me a text. Here we go. There's no video waiting room tonight either. Thanks, Doc. I appreciate you saying that. No video waiting room tonight. I don't know what happened. I was broadcasting. I guess you're seeing me now, so that's good. If I'm not seeing it, if you're not seeing me, I hope you'll say something. But so the August tariff delays signal strategy, not surrender. I already mentioned that. The pharma duties pushed back. So the tariffs on pharma definitely pushed off till 2026. Copper, copper was super volatile earlier this year. That calmed down once those tariffs went away, only in place for about a week. And now the tariffs are in the negotiating phase with multiple countries. I am certain that Trump wanted to see this happen much, much sooner, but it hasn't. So that's going to affect the Republicans and both parties, but certainly the Republicans as far as the midterms go, which are now just a year away. So the result will be this violent sector rotation instead of broad sell-off. So sector rotation, not so bad because it means that money is rotating in other places in the market. When money comes out of the market and goes into bonds or cash, that's not good for equities at all. But if it rotates to other sectors, remember very early in the program, I said, we don't just want to see technology shining. We want to see all 11 sectors shining. It's been a few weeks here, guys. I'm trying. There's so much to say tonight. So hang with me. So Trump calls this, this from previous shows, strategic uncertainty. Investors call it whiplash with opportunity. At least that's what we call it here. I don't mind the volatility, again, because we have the protection now of these put spreads. We're taking longer signals rather than having weekly signals and placing our stops in the market. I've told you guys this on the August and September shows. We're able to now wait for the monthly signals to complete, and then we can trade out of a stock that's failing, but we don't react quickly. We don't have that stop in the market. And sometimes we would get stopped out earlier than a proper signal, but that's just the strategy we had to use at our previous broker-dealer because they didn't offer this block trading in options. So tomorrow's CPI print, is the tariff inflation real or is it rhetoric? That is one of the key questions from tonight. Is this real or rhetoric as far as the consumer price index, and is it affecting consumer spending? That's what we will see. July 4th of this year, the big, beautiful bill, I'm sure you remember that. We talked extensively about it on the July and even the August shows, but certainly the July show. It's been 3 months since it was signed into law on July 4th, $4.5 trillion tax cut and $1.2 trillion spending reduction have redrawn the map. How does this affect factory investment up 340%, wages up 25%? Why is this happening? Because of the extended policies where President Trump is saying, if you want to get tax breaks in this country, you're going to need to build here. And that's where all these billions and billions of dollars from these CEOs that are coming into the White House and shaking hands with the president say, we're committing to $400 billion over the next 10 years. We're committing to $700 billion. I'll believe it when I see it, but it's still pretty impressive. We didn't see anything like that for the last 4 years. So that is why factory investment is up, because it pays companies to invest in America or get the tariff daylights out of you, right? So state budgets are diverging. Of course they do. Red states are flush with cash. Blue states are severely strained. Purple states somewhere in the middle. A state's muni bond spread tells the story. And here we are back to that spread. So if you, not that you would want to, but we do on your behalf, we will check the municipal bonds. So those are states and cities within a state that are offering fixed income. You want a bond for Springfield or for Chicago or Cincinnati or Concord, Maine, right? So if those spreads are widening, that is because there is tenseness and uncertainty in those particular states. You're not seeing that in Texas, in Tennessee, in Mississippi, and Wyoming. You are seeing that in New York, California, Illinois, New Jersey, etc., Massachusetts. So the Trump accounts, no matter what you think of this guy, you got to say this is a good thing. And take a screenshot of this when you come back if you haven't looked at what this is. Now, if you're a grandparent, most people watching this are going to be grandparents like we are, but that we finally have a way to fund an IRA for minors. All right, so think about it. You put $2,000 in, you can have the parent or grandparent match that with $1,000. So let's just say everybody does that diligently, and the 18-year-old graduates high school and his IRA, her IRA is already worth 20 grand. Rule of 72 says 72 divided by the interest rate is the number of years it takes for money to double. If that individual at 18 puts nothing in that account and doesn't work for the rest of their lives, that 20,000 becomes 40,000 at age 28, 80,000 at 38, 160,000 at 48, 320,000 at 58, 640,000 at 68. Not bad. All right. And hopefully they see that at their young age and they're inspired to save and provide for themselves and not be government dependent. I think these are a great, great addition. That's why I spent the time on this. I hope you'll go there and check this out. If you are a grandparent, encourage your children to invest in these for their kids. Best time to start is as a newborn, obviously. So what does all this mean for investors? Pardon me. A little bit of a frog in my throat tonight, guys. Sorry about that. Politics has become policy in real time. Tweets and tariffs move capital faster than laws, and we know that's the case now. Politics is conducted in tweets, in social media posts, and only then finally does it get to be legislation. And even then it gets bogged down pretty badly. The Fed is still the fulcrum, but the physical levers now matter more than the rate talk. Markets reward adaptation over prediction. I've always said to you as a money manager, our ability to adapt or to adjust is far more important than our ability to predict. And I would say that's becoming true now of the financial markets and policymakers. So this big, beautiful bill acts as a short-term stimulus, but a long-term stress test. Growth is up, balance sheets are strained, but that's not the case in every single state, as I said earlier. States that are not physically sound are going to have problems, and that is a word to them and the voters of those states. You need to vote for politicians that have a balanced budget. It's crazy that the state of Tennessee has a balanced budget, and right above it, the state of Illinois is just in massive debt. Crazy. All right? So this strategic uncertainty is the new baseline. That is Trump's MO. Trade, defense, and data policy all swing on this hinge. And in this climate, discipline beats boldness. Portfolios that bend survive the noise. Those that don't, well, that posture just doesn't work. So Jay Powell, there has never been a president who has more thoroughly harassed a Fed chair than this publicly, and how he's done this. Too Late Powell is his name and has become a slogan as well as a divisive title. The July Fed visit made history, only the fourth time in history that a president has entered the Federal Reserve headquarters. But behind the theater, what's being tested here is the independence of the Fed. I don't know what Trump's ultimate plan is, whether he wants to abolish the Fed. He certainly cannot do that. There's not enough votes anywhere to do that. But you got to find a way to get along a little bit better with the Fed director, because he can hurt you. And I'm sure Trump's thinking, well, I'm going to hurt you too. I mean, that's the kind of jostling that we have. And these are people that we're paying in office, folks. It irritates you on both sides of the aisle, frankly. So the markets are treating it like noise. The bond market is not laughing. This is the timeline. So we had rates nearly at zero in 2022. The hikes started during the Biden administration. Trump came into office in 2025. As you know, we had the first rate cut all the way in September. And now we'll see if we have one more this year, possibly two. But this is the cost of money to borrow money. 2019, we had $580 billion a year in interest expense. Right now, $1.2 trillion in interest. That's interest, folks. That's not even paying down the debt. That's just keeping up with the interest. And what is not kept up with, so to speak, or paid down, gets added to the deficit. So the deficit, obviously, and the debt are two different entities. Somehow the market shrugs this off because there is so much strength in other places, like these earnings reports that I'm telling you. But it is precarious. It's sort of like, it's okay to drive on this highway at 120 until an 18-wheeler pulls out in front of you, right? I don't know what that 18-wheeler is going to be metaphorically in the economy, but it is some concern. Japan has more debt than we have percentage-wise, 230% roughly. So for every dollar of GDP, they have 230% more of that in debt. So is Italy. We're third, actually considerably below Japan and somewhat below Italy. And you have to go all the way down. Russia's only at 23% debt. So how could they only have a 23% debt? Because they don't produce anything. All right. Our GDP engine makes it possible to survive this amount of debt. All right. But we don't want this to be in place. So, all right. As I said earlier, the number one question I've gotten since I've been in business has been, you got to tell us more about these options. So I'm going to go through this briefly. If you need to watch it a second time, everybody said, love the Schwab episode. We pulled this out. It's on the website, just the Schwab episode from September. It's about 38 minutes long of my hour show. All right. But people seem to get the householding. They get the 24-hour service. They get, a whole lot of things on that, no commissions on stocks and ETFs, but it's the option spreading that they wanted a little more history on. So I'm going to give you that. So we'll talk about what is options hedging? What are we able to do at Schwab that we weren't able to do at Interactive Brokers? So number one, we have a process for this. We don't predict. We have a process. We keep core exposure. In other words, we keep fully invested until the system says otherwise. And the second thing is we hedge the portfolio, not for each headline, but we use these index put spreads sized to shock zones. We're going to talk about the shock zones coming up. All right, explained in last month and now again in this segment. So from time to time, I bring on financial partners that help me consult. This guy is in Georgia, and I don't mean that Georgia. I mean the real Georgia, just south of Russia, okay? Really, really smart young man, options trader. So he's one of our consultants now, and he actually does a lot of speculating. So that's the other side of the options world. So it's kind of good. It's like, this is a strange way to say it, but you want to know your friends, but you want to know your enemies even better. Now, he's not an enemy, but he's on the other side of the market. So in the options world, you're either hedging or you're speculating. Well, we're not interested in speculating on the market in our options. That's what we do in our stocks, right? So we want the options to be able to hedge or to protect our stock investments. All right. So anyway, check him out if you guys are interested. Several of you have said, yeah, I just want to know more about this. So this is, again, one of our consultant firms. So check out Connor and the ODTE traders. So let's set the stage. Imagine driving a Maserati at 150 miles without airbags. You're just not going to do that. You might have done it in the 60s, but those movies are gone, right? All right, with the S&P now even higher than 6640, more like 6694, I think. Geopolitical tensions, actually 6730 today. AI bubble concern. So how do we protect against this? You can't just have stops in the market. All right. So what we do is we hedge. Now, as I just said, I told you this last time, but I just want to go over all of this again so you really understand what we're doing with your money. All right. Speculators use options to bet on short-term market moves. Hedgers like ourselves open an options position that protects us against a downside move. We don't need a protection against an upside move. We have 18 stocks in CG and GI to help us in that direction, but we do want something to help us if the market turns south on a dime, or maybe even a penny, if some crazy economic news comes out. And it's difficult to do that and rotate into more conservative stocks when the market is moving so fast. The way to protect is with options hedging. All right. So we utilize what's called a put spread strategy. So we buy put options 2 standard deviations below the market. There will be graphs coming up. Hang with me on this slide, okay? The graphs make it easier, but I need to explain this. So we're going to buy 2 standard deviations below the market. Why do we do that? Because 68% of all market moves occur in the first standard deviation. Well, then why aren't we buying them in the first standard deviation? Because we don't need to protect against that. I'm not going to hedge you or protect you from a 2% down move or even a 5 or 6% down move, but an 18%, maybe 14%, absolutely. All right, because that gets into the second standard deviation. Now, to finance that, because obviously it costs money, nobody's just going to give us those put options for free. And they can be expensive because somebody is on the other side of that trade. And if we're getting protected, and I'll show you actual customer accounts at the end of this segment, we are getting protection. But somebody has had to give up some cash to do that for us. That's not my problem. I'm buying it. They know the risk and they're pricing it accordingly. But what we do is we sell an option 3 standard deviations away below the market because only 5% of all market moves occur in the third standard deviation. So I'm going to show you the graph in a minute, but I just want to look you in the eye and say, this is not going to be a 1-for-1 mix. If the market's down 1% someday and you look in your account and it's like, well, why aren't I up? Well, it's not supposed to do that. But if you're down 0.7 and the market's down 1%, then the options are working. And actually, they increase their efficiency the lower the market goes. And I'll get into the Greeks. They call them the Greeks. Those are the components of an option a little bit later on. So that's what the purpose of this is. You're protected between these 2 zones. And here's what it looks like on a chart. So you might be familiar with the phrase a bell curve. So all the probabilities in any kind of event, you can have a bell curve for the number of antelope that appear in a field. I'm making up stuff. The number of car crashes, the number of hurricanes that are going to be Cat 5. I mean, there's probabilities for almost any statistical event that happens in humanity. Okay. What we're interested in is the bell curve for stock market returns. We're not concerned about this area in brown here. That's the first standard deviation, but you can see the 2 and the -2. We're really not concerned about the 2 to the upside because that's, again, we want it to go higher. What we care about is on the downside. So that's where we're buying options, right there where it says -2. But it's expensive. We could wait till a 3rd standard deviation or 4th standard deviation move. We're not going to do that. We're going to buy them at the 2nd standard deviation, and we're going to finance it by selling a put lower than that on the presumption that the market's not going to be down in a 3rd standard deviation move. If it is, we have a plan for that. Give me another few slides, okay? But for the most part, this cushions to the downside. And we had that happen in October. It's still been a volatile month. It's just been a positive month as well. So what it looks like is, I'm just picking a rate, and these numbers were done some time ago when the S&P was a little bit lower than it is right now. But a 20 delta, that's that little sign there. It looks like a 0, but it's not. It's a delta symbol. We're buying a put 20 delta, don't worry about what it means necessarily, below the market, and then the protection begins in that 2nd standard deviation. So once the market moves down enough that it triggers the option working, it's actually always working, but you'll see it materialize when the market turns down. And then we sell a put 3 standard deviations. So we're buying protection, we're financing at least some of it. It's not dollar for dollar, but a lot of it from selling that out of the money put at the 3rd standard deviation, right? So, makes sense? Buy the put on $100,000. If you're unhedged, you can see it drops down here to the 80,000, all right? If you have a hedge in place, the put and the short put, and it drops 20%, we may only be down 86,000, all right? You might say, well, 6,000, that's not that big a deal. This is where the acceleration of an option works. And again, I don't want to get too deep in the weeds here, but this is where the delta increases and the vega increases. And when you're long vega, your option is worth more and more. So actually, the worse the market gets, the more the options kick in and help you. The obvious question would be, well, gosh, if the market does nothing but go straight up, aren't I wasting the money? Yes, you are. Okay, so here's my example there. Let's say you're at a closing with your spouse and you lived in your house for 20 years and you paid $1,000 a year for insurance on your house and you never filed a claim. Okay. And you're at the closing going, gosh, you know what? I'd love to have that $20,000 back, right? $1,000 times 20 years. Never used it. But the bank, A, wouldn't have given you the loan, more than likely, if you didn't have insurance. In fact, certainly they wouldn't have. And would you have slept very well without that? This is peace of mind. This is that equivalent that I just told you for the stock market. So why isn't everybody doing this? Two reasons. Number one, their broker-dealer doesn't allow them to, and two, they don't know how to do it, all right? Because it's a really great strategy. So here's the mathematics. The second standard deviation I just mentioned, 68% probability that the market stays above it. So 68% of the time, you're not going to need this at all. It's those really ugly times, like 2008, like 2020, like 2022, that you really want that protection because you don't know how much lower the market's going. And it's one thing when all of us were working together, those of you that are watching that, have been working with me since 2004, I think, right? It's the longest client. We're older now, and you just don't want to have to climb back out of that in your late 60s or early 70s or older. You just don't. So that's one of the reasons we're using this. So we're protecting against the 32% worst case scenarios, 3 standard deviations, 95% probability that the market stays above it. All right. And we sell again that short option to reduce the cost of having that long option protection. I mentioned this earlier. What happens if the market keeps dropping? So if we sell at the second standard deviation, if we buy at the second standard deviation and sell at the third, once we get to the third standard deviation, if we make no adjustments, the market is going to keep going lower and we're not having any additional protection. Now, we'll still have the same protection that we had, but if we need more protection, the way to do that is to either add more long puts or move the short put away. And when this happens, I promise I will come on the show and explain, guess what, guys? It's 2020 or it's 2022, and God forbid it's 2008. Here's what we're doing. First of all, most of the portfolios will not have stocks in them at that point because they will all been stopped out and will be on the sideline. But the options will stay busy because they will still be on signal, so to speak, right? We don't really want that. It's like saying, wow, I just bought this car insurance. Let's just go out and wreck the car so I want to see how well this insurance really takes care of me. Nobody says that. Nobody. All right. All right. But we have this here for these cases when the market hits that second and or third standard deviation. All right. And that's why we're always leaving a little bit of cash in the portfolio so we can maneuver these options. So unhedged, just to review, 20% lost, 100 grand becomes 80 grand. Hedged, 100 grand becomes 86. This is not scientific. That's just an example. But what I can tell you is it's not going to be 20 versus 19. It's not going to be 20 versus 4. It's probably going to be 20 versus 16, 14, somewhere in that range. It is a nice reduction. And I think just psychologically, you know that, okay, this instrument's in there protecting me from worse losses. Okay. So one of the challenges we had this year was this huge up move on April 9th, I think it was. And this was when Trump announced his tariffs. You can see the market going straight down and then this huge up move. So we were actually stopped out of quite a few stocks in CG, not so much DS, but also GI, and had to get back in. But the market had already made that 10% move. We would not have been stopped out of any of those with our current methodology having these puts in place because they would have buffered us, if you will, from that downturn and we would have stayed in the market. So when you see these sell signals, this is going back to 2000, 2003. All right. See the big move up there. You see how in the big move from buy to sell, the second buy to sell there, the market never goes below the lower channel. Now, I'm not going to go through the channel explanation. You can go back and watch other videos, but this is our buy-sell engine, we call it. So it allows us to stay in this because, again, we have this downside protection. It creates a portfolio that's not trading as much as we have been over the past 20 years, literally, because we're able to hold on to stocks. We don't hold on to a stock that goes on a sell signal, but rather than having to take a stop in the market because we've hit that bottom of the channel and we've got to be gone, we can let the options kick in, wait and make sure that that sell signal matures on a full monthly bar, right? And then we take the sell. Usually, if we were looking on this chart, we would probably sell in some of these green bars down here at the bottom. Now, we wouldn't know that it's going to go back and hit a buy signal, right, in 2009. But the reality is that it just gives us time to slow down and think and make a more informed decision about the long-term proclivity, if you will, of where the stock market is headed at that time. So these are implemented on a quarterly basis. One of our really sharp clients, Rich, if you're listening, said, well, why don't you just do it on a monthly basis? Okay, there's two reasons. One, it would be a lot more expensive. We may find that we need to do that on occasion, but nothing this year, or certainly not last year, if we had been on the options program back then, would have warranted it. But during a COVID, during a 2022, we might have to revisit this on a monthly basis. It does cost more. It takes more of my time, but I would do it for you. I'm just that kind of guy, right? But for the most part, we can get the results that we need trading on what HMUZ. Those are the month codes for March, June, September, and December. So right now we are in the December options. Mid next month, so and that's 2 to 3 weeks from now, we will be rolling into the March 2026 options. All right. So rebalance quarterly. I just said that. Rolling the spreads 4 weeks before expiration. Why? Because the last 4 weeks is where the value of the option most rapidly accelerates. And we don't want our option to accelerate and lose money. All right. So we roll in November, we'll roll into March. And that means in February, we'll roll into June. All right. That's the way it works. So we'll adjust the strikes as necessary. So we're short, or we're long, I should say, the 610 puts in the SPY, which is the index of the S&P 500, and short 550. Well, the market's way higher than that because when we implemented these in August, the market was 20% away, or 2 to 20 delta. Well, right now it's much higher than that. So the position is a little stale. If you guys are seeing maybe that those options aren't kicking in quite as much, actually I think they are, but we need to bring them closer to where the market's actually trading, and we'll be doing that in 3 weeks. All right. So that's what that means. So we never leave the positions unhedged, and everybody that comes on and that moves over from Interactive Brokers is having their account hedged. Statistics have shown that hedge clients report 74% less anxiety. I'm not going to show you any dopey photographs of people on the beach with margaritas. I'm option hedged, so I'm happy. We won't do that. But I'd rather just show you with the math and actual account performance in the next few slides here, why people have fewer panic calls, no emotional sell orders, marriage battles reduced. And this happens, honest to goodness. That's why I said I have stories, because you'll have one spouse that'll say, I want to get out. I want to get out. Just tell him I got to get out. We had 3 clients get out of the market this year. One went in and pretty much a few weeks later. A couple others have just stayed out. All right. And you see what's happened since April. So we're hoping to create an environment where everybody can feel safe and not panic when they see the market going down, because they see that these put spreads are protecting them. All right. So this is actual market data from Friday, October 10th. So the SPX, the S&P 500, was down 0.63 overall. This is all the accounts that were at Schwab on that day. Only 82 accounts. We're at like 140 right now. But you can see a significant difference. Let's look at DS. So when you look in your account, those of you that are at Schwab or on your way to being at Schwab, and now with our medical situation behind us, I think everybody should be at Schwab within the next 2.5 to 3 weeks. That's our goal. So if you haven't heard from us, that's why. We just had some things we had to deal with here. So look at the highlighted area. You see the put here. So the market was down. This is the same trading day. You'll see that DS was actually up. Why? Because Look under the day change there. You can see in green, it's yellow background, but it's in green. The puts were up $33,000. Now, this is all of the DS clients at that time. We didn't make 33,000 total. Why? Because we actually, remember, we sold the put. So we're actually short that. We're paying somebody else 18,000, but the net to us is about 15,000. All right. So that 15,000 goes to offset the losses in the other stocks. Now you can see the day change there in Apple, Amazon. Again, this is not yesterday. This is April 10th. So the puts don't totally offset those losses, but they help. All right. They definitely help. Let's look at CG. This was even a little more dramatic. This is just one account. So you can see the S&P options here, 19,000 to the good, 9,000 against us. So about 10,000 to offset all the losses, which again, it doesn't quite do. If you look at all the red there, you'll see it's not offsetting that. But psychologically, you just feel like, okay, so it's less than it would be. If you look at the down day, look at the value change, it's down 0.04%. And you remember from up here, it's down 63%. Most people would say that's a win. All right. Now, GI, this is a portfolio. I'm getting tired, guys. Hang with me. A portfolio where there's a lot of bank stocks right now. We've changed this mix since the 10th because we just had a lot of banks. We didn't want to be so bank heavy. A lot of good dividends, but we didn't want to be so bank heavy going into earnings season. So this is not the current holdings for GI, but you'll see that Citigroup got shellacked there, down 3.5%. You've got PNC down 2.5. You've got TFC, Truist Financial down 5%. So the options did help. Still, it was down 0.73. So that's a little bit more in the S&P 500, but it would have been down a lot worse. $15,500 is what the GI options kicked in. You might say, well, so why is it different for each portfolio? And that has to do with how volatility affects the option. And those two components, the two Greeks, Delta and Vega. I know we're late in the show, so I'm not going to get into that now, but here's my offer. Some of you have said, I really want to just get into the weeds and be able to pepper you with questions one-on-one. Okay, so I am willing to do the following. I will do another YouTube show like this for anyone that wants to tune in. It won't be a regular show. It'll just be options. I probably won't do the coat and tie, and we'll just talk options. Or if you want and you're in the area, or you can fly in, we should have 2 clients that want to fly in for this. I will, I mean, so far, when we first started thinking about this, there were only a small handful of people that could fit in my office here. But maybe it's going to be too big. I'm not going to rent Soldier Field, but we'll go to one of the local, those little business places where you can go in and run a not slide projector, but you know what I'm talking about, screen, et cetera, et cetera. And then I'll take everybody to lunch. We'll have a social event on it, and we'll just really get into the weeds so you guys understand what's going on. Let me know when you get the survey on Monday if you have any interest in this. If what I've done tonight has fully satisfied you, do not feel compelled to either show up at that live event or to tune into the next video. I just want to meet the needs of every client. Some really want to understand this. Some are just happy to know, love the protection, you're doing it, good. All right. So anyway, on the survey, fill it out. Let me know what you want to do. It'll probably be early in the year that we will offer that. Guys, that's it. So if you are new to the program, be sure that you hit the little bell on YouTube, subscribe to us, get updates when we go live. I'm still doing my podcasts every week, almost every week, not getting a ton of traction on that. Let me know if you want me to continue that in 2026. Of course, I still post tweets every single day, Facebook, X, and LinkedIn. Next show, Thursday, November 13th, only 3 weeks from now, because we got a little bit of a late start here in October. These are the podcasts. You can see us on, you can hear us, I should say, Amazon, what am I trying to say? Amazon, YouTube, Spotify, and Apple. All right. There's plenty of places that you can watch it. We've got, I don't know, 80 episodes out there. You can go back. Some of them are evergreen, so you can see content. Interviews are on there. Lots of cool stuff. You want to hear more. 2 quotes while you're coming up with questions. I'm looking in here and seeing if there's anybody. And I'm again apologize. I wonder, Dr. J, if the fact that the video wasn't transmitting, I wonder if that had anything to do with the chat not working. But anyway, I'm glad you're hearing me now. So risk management is the key to long-term survival. Well, John Paulson would know. He earned $5.6 billion in the 2009 crash by protecting himself from the bank downturn. And then Bill Ackman, investing in business is where you can look really silly for a long period of time before you're proven right. Well, yeah, actually. But this is the most important one on the screen. We end it every single episode. 2 Timothy 1:7, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Guys, we are really in an interesting time right now. Think back to what I talked about tonight. September and October, so far, confounding historical norms. Does that mean November is going to be fantastic? I don't know. It certainly could be. And if that bodes well, then you remember how January goes, so goes the rest of the year. And January was up this year. So it was a pretty good start. Before I sign off, I just want to thank you all for your love and concern for my dear wife, Alice. Alice had major spinal surgery that actually was more complicated than they thought. It was supposed to be a 6-hour surgery, turned into being 7.5 hours. When she came out of recovery, she did not recognize me. So they were really, really big time meds that she's on. Meds is a nice way to say it, narcotics, to recover. She was in the hospital 15 days. She's now here. She's resting up. She's able to walk with a walker. She left the house today for the first time in a week, only for a doctor's appointment. But we're going to make it. It means so much to us that you guys have reached out, sent text. We've had clients stop by. It's great. Give a call before you do that. But I think we're back on track. We will be here for the November show. You saw the date earlier. The December Christmas party, December 6th. Feel free to fly in for that. We had 45 people last year. We're expecting probably 50 to 55 this year. It's going to be a wonderful time to close the year. It's been another year of huge blessings. My family's my greatest blessing, but next to that, guys, you are. Those of you who watch the program, those of you that are clients, we appreciate you so much. We want to bring you the best value that we can. We want to keep you educated, informed, even entertained, but edified that your money is being taken care of. God bless you all. I will see you in November. Happy Halloween. Take care.